because think about it. If you're a portfolio manager and you have a portion of your money in the NASDAQ and the big tech stocks, and your portion is 10%, that's what you wish to have. But because of price appreciation, it goes from 10% to 15%. Well, guess what? You got to sell 5% to get back to your 10. And typically people do that around the end of a quarter. Welcome back to Well Positioned. This is your host, Khayri Graves. This is the market check-in segment that we're going to be doing on this show. This is the last week of March in 2024, and we saw an interesting week so far in the markets, but definitely we saw an interesting day today. After a few days of stocks pulling back ever so slightly, they did what they typically have been doing all year and popped up higher to the upside. And for those of us who are long and bullish like myself, that was nice to see. But there was one index in particular that did exactly what I thought it was going to do, and that was outperform. I'll give you a hint. That index was the Russell 2000. On my last video, in my very first video, I spoke about how I expected investors to start to allocate money to the Russell 2000 in anticipation of the Fed lowering rates in the coming couple of months or quarters, if you will. And as that anticipation grows, I expected capital to move from some of the high-flying tech stocks to some of the laggers of the market, such as the Russell 2000, which is a basket of 2,000 stocks that are typically lower in market cap. And that's exactly what we saw. We saw that last Wednesday when markets popped to the upside after the FOMC meeting, the Federal Reserve meeting, when Jerome Powell spoke about reiterating 3 rate cuts for this year. The Russell 2000 responded positively to that, and we'll look at the IWM ETF ticker to follow that movement. And then today, when we saw, like I said, stocks were pulling back in the beginning of the week, digesting some of that positive upward movement last week, we saw today stocks then rip to the upside with, once again, the Russell 2000 outperforming. So we're going to go into some of these charts and just briefly look at the price action for today, see exactly what was the relative outperformers of the day. And we're going to kind of go across the board in all, all asset classes, or at least as many as we can, to just get a quick snapshot of how the markets are looking thus far. Now, the most important part of this video I wanted to reiterate and make sure that I made known was that, yes, we did see the Russell 2000 outperform today, have a big move to the upside, but there was something else that not necessarily outperformed, but performed really well to the upside. And it's something that we have to pay attention to, because as we're starting to see capital rotate, and that's simply what these markets have been doing as of late. They've been rotating capital from some of the high-flying names into other names and then rotating it back. So it's almost like the market doesn't want to quite correct or pull down or crash. Instead, it just wants to take the wins from the top and allocate it to the bottom. And that's what we've seen pretty much all year, pretty much since November, if you will, that rotation game. And it's funny how we're seeing markets rotate upwards. So we're seeing the upward trajectory in markets, but we're seeing it doing it in a rotating fashion. It's very interesting to watch. It just basically reiterates our bullish case here on Well Positioned as of this moment right now, that sentiment can change at a drop of a hat. But as of right now, when we see, and I spoke about this in my last video, we see that there is so much global liquidity and so much financial support that is flowing into the economy, it's flowing into the United States. The United States is acting like a magnet, just sucking in capital from all over the world. That is a huge support for asset prices, stocks, homes, real estate, things like that. So I expect that to continue. As long as we're seeing that picture continue to be painted, I expect to see stocks respond positively to that. Um, and that's one of the reasons why I encourage people to get into these markets. Start building your knowledge, let go of some of the fear of, crashes and things like that. Yes, crashes are possible, and stock markets don't ascend forever, and we've had a couple of down days, and this market hasn't been easy to trade by any means. I think one of the misnomers about the market this year is that yes, it has kind of been going up, but it hasn't been easy to trade. Not everything has been going up. Not every single stock has been going up. There's a lot of stocks that have been underperforming. There's a lot of stocks that haven't been getting a lot of love, like one of our famous darling stocks, Apple. Apple's down for the year still. Apple really hasn't participated to the upside like the rest of the market. And Apple is the number one company in the world. So that just goes to show you how interesting the stock market can be. Without further ado, let's go to one quick commercial from our lovely sponsors, yours truly, of course. And after that, we're going to jump right into the charts. Stay tuned.
You are going to get left behind in this economy because your finances are not well positioned. My name is Khayri. I'm here to expose the right way for retail traders and investors like you and me to approach financial markets. So before you start day trading or buying financial products, you need to understand certain principles to ensure you're well positioned to build wealth over the long term. This is how a really good trader is formed, by trading with a purpose and a more significant objective. So, do you want to learn how to construct the best wealth building portfolio? Then I suggest you click the link in the description to purchase my book, One Small Tweak. This book will expose precisely what products go into our foundational portfolio and then how to tweak these products for superior performance. And lastly, for your life insurance needs, I am currently offering a free 15-minute call. So, whether you're someone who needs consultation on the best policy type, I specialize in term policies and policies that are designed to build wealth.
All right, into the charts we go. This is Thinkorswim, one of the best trading platforms in the world. I have no affiliation, but I've been using this platform since 2016, and I've gotten pretty good at it. It's a lot of buttons and gizmos and toggles and things like that to learn, but as you do learn, it will make you a better trader because of the amount of resources that this trading platform provides. One of the resources in particular is what we're looking at here, and this is called a flexible grid. Flexible grid allows you to see a snapshot of various different markets at one time, almost similar to how you see traders, when in a big trading room, maybe at like the New York Stock Exchange, and they'll have all the screens everywhere, all over the walls, and everywhere, and that allows them to see different markets all acting in real time. And that's what I like to see when I'm trading or just simply just trying to check the temperature of the market. So when we do our market check-ins, we'll use this visualization quite a bit, but we may also use other ones depending on what I see is important. But let's get right into it. So we'll quickly go over how the major stock indexes performed. We'll quickly look at the S&P 500. It had a kind of a bearish day in the beginning and ended up going much higher toward the close of the day. Now, keep in mind, we are getting close to the end of the quarter. In fact, this is the last trading week of the quarter. And one of the things you'll find is as a quarter starts or ends, you'll see a lot of activity in the market and a lot of kind of, I don't want to say suspicious price action, but you'll see price action that may look unusual to the previous trading days. And a lot of that is because portfolio managers and folks who are managing a large amount of money, they often like to rebalance their portfolio before the end of a quarter. And they may want to move capital from a place they haven't been or take capital from a place that they have been for a long time and just do different types of reallocation. And typically they do that by sending everything up higher, and it allows them to rebalance their portfolio a little bit easier when things are trading higher. So that is one way. That's just something I've noticed, from quarter to quarter. I see a lot of times if, one of the last couple of days of the quarter, you'll just see weird price action. Maybe sometimes everything will be down, sometimes everything will be up. But usually there's some bit of activity. And a lot of what that could mean is that investors are positioning themselves for the next quarter, because portfolio managers and people who do this from an institutional level, they have to report and disclose their holdings for the quarter and then their holdings for the year, because that reflects their overall performance of their job, if they're doing, if they're doing well for their clients. So one of the things we start to see is that if portfolio managers are behind on a position that they should be in and they're not, they may do some type of panic buying toward the end of the quarter just to make sure that they get into position. And that's essentially on this channel what we are about. We are about being well positioned and understanding how capital on an institutional level has to be positioned in order for these folks to keep their jobs. And there's certain things that capital has to do at certain times in order to be on the right side of markets, to be on the right side of data as it's being rolled out. So that's something that's very important. We want to make sure that we are thinking about these markets in the right way and trying to get a concept, an idea of what does a portfolio manager have to do in this instance to keep his job, right? Now, luckily for myself and for, probably a lot of people who are watching this, you don't do this for a living, right? But in many ways you do, right? Because we're seeing that inflation is causing our standard of living to decrease so much that we need an extra boost in our finances. And the stock market is going to be the way to help us do that. I truly believe, and actually my belief doesn't matter. From what I've seen is that those who are able to maintain and even better their lifestyle over, through these inflationary times are people who own assets. I own a home, I own stocks, and I've been able to, for the most part, keep up with my standard of how I like to live my lifestyle. I've pulled back in many ways in different things, but for the most part, I've been able to at least keep up. And I want the same for anyone who is listening. That's very important to note. So moving forward, as we're looking at these charts, and like I said, we did see the S&P. Sorry for my little rant there, but just wanted to get some of that out. We did see the S&P was up 0.8%, almost close to 1% for the day. Did really well toward the close. That was great to see. We see the NASDAQ. See, the NASDAQ was the lagger of the day. Really had a bearish move to the downside, gained some footing, throughout the middle of the day and then rallied toward the end of the day, but didn't quite take out the highs for the day. And it was only up 0.34%. If we're looking at the Dow Jones index, had a pretty strong day, nice strong up move, kind of maintained a sideways to upward trajectory throughout the day, and right around the last hour of trading, boom, ripped higher to the upside, and we're seeing that across the board in all of these markets. Now, the one index that really stood out, and I've been keeping a very close eye on, because even in my long-term portfolios, I started positioning some money into some of the smaller cap names, because I do believe that capital will start flowing to these, almost trying to do somewhat of a catch-up trade in anticipation of the Fed lowering rates at some point this year. Because what I spoke about before was that these companies in the Russell 2000, they hold a lot of debt. When the Federal Reserve lowers interest rates, it actually decreases their cost of capital, their cost of debt management. So as they're paying interest on their debt, if that cost comes down, that effectively betters their profit margins. So rate cuts to companies like these smaller companies in the Russell 2000, they are very sensitive to rate hikes and rate decreases. A company like Apple or Face or Meta, if you will, companies like that, they have so much cash. They're so strong financially that a rate cuts or rate increases don't really affect them too much because they're not carrying a lot of debt in order to operate. But companies like these in the Russell 2000, different story. We see that they underperformed throughout the year, but now I think they're starting to get some love. So what we see here, 2.18% to the upside. Like, wow, what a big move. And we saw here back on Wednesday, big move on Wednesday. This was similar, almost a 2% move that day, I believe. Yeah, yep. So we're seeing that big move to the upside on last Wednesday, kind of traded sideways, caught its breath a little bit, and another big move to the upside again. In fact, let's look at a daily chart of this and see how far along we've come. So we're starting to see the Russell's really getting some traction going for the year, up about up finally above 5% for the year. So it's getting some footing. It's got a long way to go before it reaches all-time highs. There's no doubt about that. But that's okay. That's okay. I believe that if the cutting story, interest rate cutting story goes well and it continues to play out favorably in the way that the markets are anticipating, so that's the main thing. If markets are anticipating something, as long as expectations stay within anticipation, right? As long as expectations stay within what is being anticipated, then we should expect that this trade, as it is going, will continue. And I do think we could possibly see all-time highs in the Russell 2000 before the year is over. You can bookmark this video and we'll see if I'm right by the end of the year. But I do think there's a good chance that I will be. Like I said, as long as the rate cutting story stays the same. If we start getting some really inflationary data that comes to the table and we start to see the Fed change their tune about cutting rates, and I mean, we started the year with 6 rate cuts on the table and now we're down to 3. So anything could happen. But just wanted to point that out. So we see the Russell had a big day, was the number one outperformer for this week so far, and definitely on the day. However, before we get out of here, I want to go over one asset class, if you will, that kind of stood out to me as I was analyzing markets and looking through my watch list and watching price fluctuate. I did notice something interesting, and that's the bonds. The bonds also had a big day. The bonds are up almost 1%. This is the TLT to be exact. This is a bond ETF. If you look here, this is the iShares Trust 20-year Treasury bond ETF. So this is like a bond ETF. It's like a mix of different types of bonds kind of put together in one. And this is a typical bond trading product that traders will use to basically reflect the price fluctuation of bonds. This is something I've traded before. It's very liquid. You can trade options with it if that's something you're into. You can hold it long term in your portfolio if that's something you into. But if you get my book, I talk about how that may not be a good idea. You may not want to hold these bond-like assets in your long-term portfolios, especially with inflation going higher and higher. That's not good for bond prices. Pick up the book, One Small Tweak, by the way. It goes through all of that. It gives you a better bond and a better portfolio setup. But anyways, looking at the TLT, we see that it was up 1%. So very interesting. As we saw the Russell 2000 making a big move to the upside, we also saw bonds making a big move to the upside. Almost, and if you look at the price action, it's very interesting. It's almost in lockstep, you know. And that makes me kind of wonder. I think what's happening is I think we're seeing investors and traders say, hey, I think this Russell 2000 trade can work and it should work, and they hope it will work, so they'll allocate capital to it. But they may be hedging their bets by also buying bonds at the same time. You see that they're selling. I don't want to say they're selling out of tech. This is not, I would not call this selling out of tech, but maybe trimming some of their tech position or taking profits in their tech position. Because think about it. If you're a portfolio manager and you have a portion of your money in the NASDAQ and the big tech stocks, and your portion is 10%, that's what you wish to have. But because of price appreciation, it goes from 10% to 15%. Well, guess what? You got to sell 5% to get back to your 10. And typically people do that around the end of a quarter. So we could see some trimming here, some profit taking here, and then money going into other asset classes like the bonds and like the Russell 2000. But we're seeing them doing that almost in lockstep. Now, this is one day of trade. We're not going to take this and run to the bank with it, but it is just, it's very interesting to note. So, so let's definitely keep that in mind as we're moving forward and as we're looking into Q2. I want to see if this kind of pairs trade, if you will, I want to see if that continues, because if it does, that could be very interesting, and also gives me a bit of caution as I'm moving forward, because if you're buying bonds, that's typically a defensive position, meaning that typically bonds are purchased during a time when when investors feel growth is slowing, um, when they feel a recession may be on the horizon and they want to maneuver money into a safer asset. Or it could simply be, just, portfolio rebalancing. Bonds underperformed. If we look at the TLT on a daily chart, let's look at a daily chart for the year so far. We see that bonds are actually down for the year. Bonds are down. Bonds are down 3.5% for the year, even with this big move that took place today. So this could be just another catch-up trade similar to the Russell 2000. Who's to say? But we're going to keep listening to the market, listening to what the market has to say. See, when price hits the tape, when price action happens, that's the market talking to us. And if we want to be good traders, we want to be good investors, we want to be good market participants, and if we want to be well positioned, we have to listen. We have to listen to what the market's saying. The market speaks in numbers, it speaks in relative strength, it speaks in price performance. We have to listen. We keep our ear to the ground and we can make better decisions as we move forward. So, without rambling on too much more, I want to thank you so much for tuning in. We'll be back with another market check-in pretty soon. We'll see some we'll wait for some economic data to hit the tape over the next couple of trading days, and we'll see where we're at. We'll see if this particular trade continues. We'll see if things change. We'll see if my feelings or thoughts change. But for now, we're still bullish. Let's keep making money and do what we do best. Stay well positioned. Till next time.